Welcome back, everybody. Today I'm talking about the dividend portion of my portfolio. I have almost $200,000 invested into equities that produce a monthly dividend. And over the course of a year, I should almost make about $20,000 from the dividend side of my portfolio. And that's pretty crazy to think about, since it's basically saying that for every $50,000 you have invested, you can get paid $5,000 in dividend income, which is a really high yield. That's like what, 10%. And I'm gonna go ahead and talk about the ETFs that I've went into and why I chose them. But first, I want to take a jump back in time to some point mid 2020, and that's back when I was trying to build my own portfolio using individual dividend stocks. And this is going to like an old spreadsheet, so a lot of stuff has changed since here. But you can see, like, I was going through and trying to pick up like all these good dividend aristocrats that people would say was safe. They would always be paying a dividend forever, and that would never be threatened. Not looking at you, AT&T. And I spent a lot of time picking the stocks I wanted to put into this portfolio, and I found myself very distracted by having to follow all these companies to make sure that they're doing what I thought they would do, and that my dividend was not being threatened, that kind of stuff. Like, it was very distracting for me, which was not a good thing, since at that time I was starting to explore how to trade options to make additional income. So having my focus kind of split between the two things wasn't the best thing for me. But I will say that even the snapshot here kind of shows you like the benefit of just buying and holding forever. So at the prices I got in at for these, had I held them all, a lot of them had some pretty insane returns. In fact, it says that like my small portfolio back then of 13,000 in dividend stocks would have became 20,000 if I just held forever, basically, or at least until this point in time. Now you can see, like, at this time I was just starting to build out my dividend portfolio, but I was mostly in cash, and that's because I was also exploring options. And the idea was going to be that I'd slowly DCA into all these positions. Like, I built out my shopping list and would buy whatever's on sale for that week, kind of thing. But eventually, I decided to scrap that all, stay in cash, and play options. And after a year of doing that with some pretty good success, I did move into wanting to have that cash do something instead of just sitting there to secure the option plays. And that's when I started getting into the ETFs. But I will say it was pretty fun to like go through and build a spreadsheet to track all this and go through and see how much I would make each month depending on when stuff paid out. But let's go ahead and jump forward and talk about some of these ETFs that I ended up deciding to go into. So I'm mostly in 4 ETFs right now. I may add some other things later. I did just sell my MFA position finally. They were going to have a stock split, reverse split, so 4 shares became 1 share. I didn't like that. I thought that might make some selling sentiment happen, so I cashed out on that one. So sad to see that go, but probably long overdue. Right now, my portfolio is made up of 4 ETFs, and they're pretty popular. You got QLYD, JEPI, SCHD, and DIVO. So first off, I'm going to talk about SCHD. So right now, I own 120 shares of SCHD. This is the newest position in my portfolio. I plan on adding more to it because I feel like it has a lot more growth potential compared to the other ETFs in my portfolio. And with 120 shares, I should expect about $248 a year in income from that, which is pretty nice because it's still the fund that should grow the most out of all these pieces. And I plan to add more to this. In March, I actually skipped contributing money, so April I should do like a double contribution for my monthly contribution, and I think that all might just go into SCHD to kind of help bolster that position a little bit, especially since the market just went down. I might as well get in because it's on sale, kind of thing. I'm looking at Seeking Alpha here. You can see that the expense ratio is really low, and people would substitute DIVO with SCHD, but where the fight comes in that people have a hard time overcoming would be the fact that SCHD has such a low expense ratio, whereas DIVO, which is a similar fund, has like a 0.35% expense ratio, I think it is. And basically, you can see over time, this does in fact grow, which is what we want to see. Let's go to the max real quick. So that's kind of the goal of putting money into this position, is that I will capture some of the growth with this money that would otherwise be sitting cash securing option plays. So the third largest position in my portfolio is DIVO. I kind of see like DIVO and SCHD being like brothers. They're very similar in what they do, but DIVO has a higher expense ratio, and they only hold about 25 holdings. They tend to be blue chip stocks that should be around for a long time, and they sell covered calls on 30 to 60% of their holdings, which is why they can they have a little bit less growth potential than SCHD, I feel like. But as a result, their yield is actually higher, so it's 4.83% right now, and SCHD in comparison is about 2.6%. So the estimated income that I should be receiving from DIVO is actually about $2,000 a year. Now, looking at DIVO here, you can see again, it's another one ETF that is going up over time. Let's go to Max, and you can see it's growing up, just not quite as fast as SCHD. So I view these two as like my main growth ETFs in my portfolio that just happen to pay me income like every month for DIVO and every 3 months for SCHD. The DIVO holdings, you can see there are companies that you recognize. And basically, instead of me buying all these companies by picking the individual stocks, I'm letting an expert pick them and weigh them accordingly and adjust as needed. So I don't have to think about that. So that's why we do have a higher expense ratio here. 0.5%, was it? 0.55%. So that's basically what DIVO's doing, is they're taking 25 companies, they weigh them, they sell covered calls, they pay out some of that as income to the shareholders. Next, we have JEPI. I own 658 shares of that. The estimated annual income from that is about $4,300 a year, which is pretty cool. The yield is about 10.5%. This does bring up my portfolio yield significantly as a result. So this is why you can kind of see how $200,000 invested gets me $20K a year in dividends for passive income. So JEPI, what I like about JEPI is they have more stocks in their holdings. They have about 102 large cap stocks in them, and they sell covered calls on those. And again, it's another one that should get a little bit of growth. They sell covered calls on a larger portion of their holdings than the other ones. You can see over time, again, it's another one that has potential for growth. And with the covered calls, that acts as a hedge as stuff goes down a little bit. So JEPI is another one that I really like. The expense ratio is lower than DIVO at 0.35%. And I don't know, I just think it's a solid pick. I rarely see anyone say anything negative about JEPI specifically, but my largest holding, that's another story. A lot of people love to hate on QYLD. So my largest holding by far is actually QYLD. At one point, the weight was at 60%, but I'm not adding to this position. I'm adding to those other ETFs right now. So in the future, QLYD would become a smaller portion of my portfolio by virtue of it not getting additions besides what gets dripped in from the dividend. So I own 5,063 shares of QYLD, and every month that's dripping like 50 more shares, which is awesome. That's about a $10 increase in monthly income every month as a result of that dividend reinvestment plan being turned on. Right now, it's estimated that I should make $12,740 from QYLD if I just set it, leave it, and let it just do its thing, which is a lot of money, and that's a nice little safety net to have in case something bad was to happen to me, or like if I lost a job, something along those lines. So QYLD, a lot of people hate on this one because they say you're just giving up all your growth for income on a deprecating asset, and it's tough to argue against that. Like DIVO by design, or not DIVO, sorry, QYLD by design should not be going up too much because they're selling covered calls on all of their positions. But what people don't realize is that a large portion of the income they make from selling the covered calls goes back into the fund itself. Only a fraction of that gets paid out as a dividend. So it is buying more that offsets that deprecation effect. Now, I don't think QYLD is going to be one that goes up above 25 anytime soon. I kind of feel like over time, it's just going to hover between like 18 and 22 and that's just my take on it. If the fund generates less income from selling covered calls, that's where I could feel like QLYD could become hazardous. Like they can run into some issues there if the premium that they can receive goes down. But that's not what I hear people talk about. They just talk about, oh, you sell covered calls and you get no growth. Okay, well, to each its own. Now, me personally, I don't need this to grow. Like I'm making my growth from selling options, and if you follow me at all on that, you've seen I've had great success with that. So this is just something to park some cash in so I can collect a little dividend. And if I do need to pull out cash to secure a position, I can sell this, and this would hopefully be something that doesn't go down too much. Whereas if I was invested in individual stocks, those could drop a lot more drastically. A great example is actually this week. So QLYD sold some calls, and because of the delta, while the market's been going down this entire week, QLYD's only experienced about 20% of that downward trend, whereas like your individual stocks obviously take 100% of that hit. So it's really neat because the cover calls can act as like a hedge, and that's why you can see like QLYD has not dropped a lot this week compared to other stuff, because the cover calls are just great. So now here's a report from my brokerage that shows the dividend income that I've received so far, and you can see that they're just paying. They're doing what they're doing. They're just giving me monthly income for a majority of these. SCHD only pays once every 3 months, but everything else is a monthly payer. And you can see it's just consistent income hitting my account. About $1,000 a month so far, it feels like. But if you look over here, January was $1,200, February was $1,100, March QLYD paid out twice, like the pay date. The way they lined up is they paid out twice in March, so like $1,700 for March in dividend income. And even in April, we've already received $300 in income from the ETFs paying out. Like, it's really neat to see. I just love seeing this passive income come in that takes no extra effort on my end. It's just, here you go. Here's free money, it feels like. Looking at the projected income, it is what you expect it to be. What I like here is it does sum up your estimated annual income. It just put me just under 20,000 here. It even tells me that I should earn another 14,000 throughout the course of this year. And this excludes like the drip that's going on. So like these should be underestimates because I'm buying more shares every time the dividend pays out. So I know I'm going to get a couple comments down below where people are going to say I'm too young to be investing in these income ETFs. These are designed for people that need income now or in retirement, that would rather have the dividends than to have to figure out how much to withdraw from their portfolio each month. And especially since I just have all the dividends being reinvested into the asset, I'm just buying more of a depreciation asset. But my counter to that is I don't need this to be growth, or at least not much growth. And that's because I rely on my options trading, where I basically sell theta to people and maybe take advantage of a little volatility here and there. So this year, I'm up 20% almost year to date. And I think that has me covered in terms of growth. So I'd rather have my money invested in these income ETFs where I get paid those big dividends that just kind of make my day like, whoa, that's $1,000 for doing nothing from QLYD. And I like seeing that. It just gives me peace of mind, and it's a lot easier than managing individual stocks while I focus on my options trading. I hope you guys enjoyed this video. If you did, go ahead and hit the subscribe button, and I'll see you guys next time.